On today's show, we are diving into the future of the housing market amidst all this economic uncertainty. And to help us with that is seasoned investor Jay Scott. We'll discuss how the market might perform in the coming months, if the US could see a mild recession, tariffs, and what other economic factors investors should keep their eyes on. I'm Kathy Fettke, and welcome to the Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
I cannot believe it's the first time we're having Jay Scott on the Real Wealth Show. He's the author of Recession-Proof Real Estate Investing, and he's also an expert on the economy and an active investor today. Jay will be sharing his thoughts on what investors should be worried about in this current economic environment. Jay, welcome to the Real Wealth Show.
Thank you for having me, Kathy. I'm really excited to be here.
We're going to throw some tough questions at you today, but I know you're going to be able to answer them. So let's start with all the changes going on today and a lot of uncertainty out there. Where do you see the housing market over the next few months?
So I think the bigger question is, where do we see the economy over the next few months? Because in some respects, that's going to drive the housing market. That said, the nice thing about the housing market is, for the most part, it's been decoupled from recessions for most of the last 150, 160 years. So we've had 35, 36 recessions in the last 160 years. And there's been 3 or 4 where real estate has taken a hit. And there's only been 2 where real estate has taken a significant hit. We have 2008, and then we have the Great Depression. Other than that, for the most part, even if the economy goes into a severe downturn, for the most part, real estate is unaffected. And so one of the nice things about real estate is that we don't necessarily have to worry about recessions. I'm not saying a recession can't impact the housing market, but it tends to have much less of an impact than it does on other asset classes. So yes, I think the broader economy could impact real estate, but I'm not overly concerned that we're in for a major crash, even if we do have a bad economic outcome over the next few months.
Why do you think that is? Why do you think that housing's not really necessarily tied to recessions, when you and I are both obsessed with the economy and believe that it has everything to do with it?
Yeah, for the most part, it's because housing isn't just an investment asset class. People buy and sell stocks based on their investment needs, based on future wealth goals, based on whether they think the market's going up or down. They do the same with bonds. They do the same with gold. They do the same with businesses. They do the same with all other asset classes. And I'm not saying there aren't people out there that buy and sell real estate as an investment, but for the most part, most owners of real estate are people that own real estate for their personal benefit. They use it because they need a place to live. And when you need a place to live, you're not going to necessarily sell simply because the market's softening or the market's getting better. You're going to be looking for stability for you and your family. And so unless you're in a position where you're forced to sell, maybe you can't make your mortgage payment, maybe your job moved you across the country, maybe there's a death in the family and you're selling the house because it's no longer needed. Those are the reasons that people tend to sell their property or buy new property. And those don't necessarily correlate with economic events. And so I'm not going to say again that housing isn't somewhat correlated to the broader economic environment, but for the most part, it's not as correlated or driven by the economy as other asset classes.
Okay, but market specific, obviously we want to see how certain markets are doing. When we look at a national recession, that's one thing. But if you're in an area where there's a lot of job losses, that can really affect the real estate. So where do you see potentially job losses in the future? I mean, we're already seeing it, right?
Yeah, absolutely. I mean, the 3 biggest things that are going to impact housing on a local level are: 1, population growth or decline, employment growth or decline, so businesses moving in or moving out or laying people off or hiring, and then wage growth or decline, people making more money or people making less money. And so if you follow those three things, again, where are people moving, where are businesses moving, and are wages going up or down in those areas, that's going to give you a really good idea of whether you can expect the housing market in those areas to improve or to decline. Where do we think that we're going to see those numbers decline over the next few months or years? Well, I think the biggest area that we need to look at is Washington, D.C.
Yeah.
and surrounding areas, Maryland, Virginia, because we know that what's going on right now with federal layoffs is that there are a lot of people who are losing their jobs, and not just federal employees. Keep in mind, for every federal employee out there, there's probably 2 or 3 federal contractors. So non-federal employees, people that work for private companies, but who get paid through federal contracts. They're contractors to some degree. And so when we lay off federal workers, when we stop funding federal contracts, it impacts contractors as well. And so for every 100,000 potential federal employees that we're laying off, and the number is in the hundreds of thousands most likely over the next few months, it's probably going to be several 100,000 more contractors as well. So we could be at the 2, 3, 400,000 layoff level, of which a good 50 to 60% are in the DC metro area. So that's the biggest area that I'd be concerned about right now.
It seems like some of the new policies of this current administration is meant to bring jobs back to the U.S. So do you see that happening yet, or a potential for new factories, businesses coming to the U.S. where there might be a boom?
Yeah, I think there's a good chance that we're going to see more manufacturing coming back to the U.S. Now, should that be the goal? That's a completely separate discussion, because I think the likelihood is, even if we do see manufacturing coming back to the U.S., it's going to result in a rise in prices. So there's a reason why that manufacturing left the U.S. in the first place, and that's because there are other places in the world where those things can be made more cheaply. Either they have the natural resources, or they have lower labor costs, or they have worse labor laws. People can work when they're children, or they can work longer hours, whatever it is. I'm not saying there are good reasons for it, but there are reasons why we have moved offshore a lot of the manufacturing in this country. And again, it's specifically price related. You can get things cheaper. Moving things back in the US is likely going to make things more expensive. Now, there are times when more expensive really doesn't mean anything. It shouldn't be an issue. National security. There are things that we do in this country for national security, or should be doing in this country for national security. For example, making electronics and chips. So right now we're getting a lot of our chip manufacturing is coming from Southeast Asia, from Taiwan. We should be doing that in-house, because if there's ever a supply chain disruption, that's one of those things that we really don't want to not have access to. So things like chips and electronics should be brought back. Things like medical and medicines, pharmaceuticals. Those are things that we really don't want to trust other countries to be making for us and shipping to us, because, again, whether there are geopolitical issues where they don't want to sell those things to us, or there are supply chain issues like there were with COVID, where they just can't get things to us, we don't want to put our constituency at risk of not having the medicine and the pharmaceuticals that they need. And so there are certainly things that we should be making in the U.S., even if it's more expensive. As for the other things, should we be making them here if they're more expensive? That's more a political and an economic discussion, and so that's kind of above my pay grade.
As you know, we have a build-to-rent community in San Antonio. We also have a rental fund in a chip manufacturing area in Sherman, Texas. And that's why we chose that market, because the Biden administration actually was incentivizing chip manufacturing to come back to the U.S. And they're saying that is for a national security reason. So investing near where those sites are is obviously a good idea. You have a podcast, and on your podcast, you've been tracking jobs. And I think one of the things you guys have been saying is that a lot of the jobs that were created over the past few years were government jobs. I mean, did you say that?
No. So
I think someone on your podcast did.
Yeah, I think AJ said that. If you look at the data, we're both kind of right. So the number of federal jobs created has gone up over the last couple of years. That's 100% correct, but it hasn't gone up as much as a lot of people think. So historically, we're at somewhere between 21 and 22% of job growth is going to government employees at the federal or state level. Last couple of years, it's been closer to 23.5%. So a couple percent difference. Now, keep in mind, across 300 million people, 180 million people working, that couple percent is a lot of people. So depending on how you look at it, yeah, the number has grown. Has it grown that much? Probably not as much as a lot of people think, but yeah, it's gone up at least a little bit.
So with that reversing, with this new administration, do you see the risk of recession over the next couple of years or this year?
Yeah, so I mean, a lot of people would argue we've been in a recession for a couple of years. The
A
problem
lot of
with
people think
recession
that,
is,
yeah.
yeah, a lot of a big problem with the term recession is we don't have a universally agreed upon definition. So a lot of people, especially the media, would say if you have two negative quarters of GDP, so total economic output, that's a recession. Technically, that's not true. Technically, there's this organization called NBER, National Bureau of Economic Research, and group of people that get together every few months or every few years, and basically they decide if something that happened in the past was a recession or not. And so if you're ever looking at the graphs of economic data and you see these little gray bars throughout the graph that indicate recessions, that was because this organization NBER has said, yeah, a recession started here and ended here. And normally it aligns with that GDP going down number, but not always. And so, and then other people would say, hey, it doesn't matter what NBER says, it doesn't matter what GDP is doing. If I feel like I'm having trouble finding a job, if I feel like I'm having trouble putting food on the table, if I feel like I'm having trouble putting gas in the car, it's a recession. I don't care what anybody else says. And so we don't really have good definitions of recession. And certainly there are a lot of people in this country that over the last few years have been struggling. We haven't seen wealth growth across the board. We've seen this wealth gap where certain people are making a lot more money. They're building more assets, they're building more net worth, and then there are other people on the other side of the socioeconomic spectrum that are losing net worth and are having trouble making ends meet and are having trouble dealing with the inflation that we saw a couple of years ago that hasn't really gone away in terms of price increases. And so depending on your definition of recession, you can argue that we may have already had one. You could argue that we may be in the midst of one. And I think it's certainly safe to say that there's a reasonable chance that we are heading towards one. And there are a couple of reasons for that. Number one, it looks like GDP growth, that total economic output number that we like to look at, there's a really good chance that in Q1 of this year, so the quarter that's ending in about 2 weeks at the end of March, could be negative. And that would be the first time that we've seen a negative number there since COVID. And so that's a really bad indication of what's going on in the economy. It basically says the economy is contracting. Job numbers aren't that bad. Actually, if you look, job numbers right now are actually pretty flat, pretty much the same as they've been the last 6 or 12 months. But as we talked about, we are in the midst of a lot of federal job layoffs. We're starting to see a lot of contractor layoffs. We're starting to see a lot of tech layoffs. And a lot of people think that those numbers just haven't hit the metrics yet. And that come the end of March, beginning of April, when we start seeing March numbers come out in April, that we're going to start to see the reflection of all of those federal cuts and tech cuts in the jobs numbers. And so there are a lot of people who think April is going to be a really ugly month when it comes to jobs. The other big thing, and this is really important, and we don't have as hard of metrics around this, but it's often been the single best indicator of where the economy is headed is public and business sentiment, public confidence in what's going on.
Yes.
So when people are concerned about the economy, when they're concerned about not being able to pay their mortgage or concerned about losing their job or concerned about getting downsized and losing hours at their job, what they're going to do is they're going to start spending differently. And when businesses are concerned about the economy, they're going to start doing different things with their inventory. They're going to start doing different things with their prices. They're going to not hire as many people. They're not going to build as many factories. And so just this idea of believing that we're heading towards a recession is going to change people's actions in a way that may actually lead us into a recession. And what we've seen over the last couple of weeks is some of the worst consumer and business and investor and fund manager sentiment that we've seen since, again, COVID. Consumer sentiment, so University of Michigan does a study, and consumer sentiment is down 22% since December. And it's not just people who say, I loved Biden and I hate Trump, and so now I'm going to say things are horrible because Biden's gone and Trump's in office. This is across all age groups. It's across all political affiliations. It's across all stratus of wealth, education, all different geographic locations. So consumers across the board are basically saying that they are a lot less confident about the economy than they were. And the big thing that they're saying they're not confident about is inflation. Number two, business owners. So business owners are often the single best leading indicator of where the economy is headed. Because again, if business owners think that the economy is heading towards a bad patch, they're not going to hire, they're not going to buy a lot of inventory, they're not going to expand their businesses, they're not going to buy more vehicles or factories or equipment or warehouses. And all of those things that they stop doing actually have an impact on the economy. Small business owners have basically said that inflation is their biggest concern and that there's a ton of uncertainty amongst small business owners these days. 32% of small business owners indicated that they raised prices last month because they were concerned about inflation. They were concerned about the cost of their goods going up. And so that's the biggest number we've seen since April of 2021, I believe. And so when business owners are so concerned about inflation that a third of them are raising prices preemptively, that's something that we need to be worried about. If you look at fund managers, Bank of America does a fund manager survey every month, and fund managers basically have said they've moved 40% of their holdings out of U.S. equities, out of U.S. stocks over the last month. That's the highest number by far that we've ever seen fund managers move money out of the stock market, and that's been reflected in the stock market. We've seen that over the last few weeks. If you look at analysts, CNBC does a monthly survey of analysts, and they rated the risk of recession at the highest level in nearly 2 years last month. And then finally, investors. So regular investors like you and me, there's this organization called the American Association of Individual Investors. They do surveys as well. 60% of just individual investors like you and me have said they are bearish on the market right now. That's a much higher number than we've seen in the recent past. And so whether it's consumers, business owners, fund managers, analysts, investors, everybody's saying that they're concerned right now. Their sentiment is down, their confidence is down. And again, when people are concerned and confidence is down, that leads to them acting in a way that very well could impact the economy negatively.
Yeah, wasn't there a stat that like 80% of our economy is based on consumer spending? Something like that. Yeah.
Yeah. And if you look at the typical inflation numbers like CPI, the Consumer Price Index, you'll see that a very large percentage of CPI is made up by consumer spending. There's also housing and transportation and other things, but consumer spending makes up a really large part of that. Same with GDP, this gross domestic product, the total output of the country, that's like 60 or 65% consumer spending. And so when consumers stop spending, that hurts the metrics as well as the economy. In fact, another thing to look at is what are CEOs saying about the economy of big companies, not just small business owners. You've got Dollar General. The CEO of Dollar General has basically said, and this was a quote in the last analyst meeting, that consumers are very cash strapped. He used the term cash strapped right now, and a lot of them can't even buy necessities. Walmart and Delta both came out. The CEOs of Walmart and Delta both came out and said they've seen a major change in spending patterns, and it's across the spectrum of wealth. So Delta said they've seen it in their general boarding categories as well as their first class cabin, that there's been a big change in spending patterns. Walmart is saying there's a big change in spending patterns. And so, yeah, consumer spending is the big thing we want to look at, and it sounds like that's starting to change.
Well, as an investor, and you are an experienced investor and still active, I think you started your career flipping houses, right?
Mm-hmm.
And then moved to multifamily buy and hold or flipping. Yeah, because so many people were buying apartments to flip. What are you currently doing and feeling comfortable doing? Because when I say, are you still interested in investing? Well, that could mean so many different things because there's so many different strategies that may or may not apply today. Yeah. But where are you most comfortable, or how are you most comfortable investing today?
Yeah, I still love real estate. I mean, I'm sure you would agree with me with what I'm about to say, but real estate is the single best hedge against inflation and probably recession than any asset class on the planet. So if you have to have your money anywhere, if you're concerned about inflation, if you're concerned about the economy, real estate is the right place to have it. Now, there are lots of different ways to invest in real estate. And the two biggest are you flip it, you buy it to resell quickly, or you hold it and you basically you plan to not resell it for 3 or 5 or 10 years. I'm a big fan of during times where we see inflation and economic uncertainty that we're doing strategies that are at least 2 or 3 or 5 years out. I'm not a fan of flipping houses right now. I wouldn't want to be buying a house that I have a 3 or 6 month hard money loan on where I need to get it renovated and resold in 6 months because who knows where the market's going to be in 6 months. It could be a lot worse than it is now. It could be even if it's not the housing market, the economy in general could be worse, which means there could be fewer buyers out there. So I don't like the strategies right now that involve requiring the sale of a house in the next few months. That said, any strategies where you can or plan to hold a property for at least 2 or 3 or 5 or 10 years, I'm still a huge fan of. If you look again at the historic recession patterns, what we see is recessions typically last somewhere between 12 and 18 months. And so if a recession were to start today, let's say, there's a reasonable chance that by 2027, things are back on the upswing, that we're back in the next economic expansion period. And so if you can hold the real estate that you have, if you're buying real estate and you buy it intelligently, you buy it with a mortgage that you know you can pay, you have some reserves on the sideline, that you are being conservative when you model your expenses and your rent growth and your occupancy and vacancy, and you know that you can weather a 1 or 2 or 3 year storm, you can be pretty certain that when you come out the other side in 3 or 5 years, that investment will be worth more than it is today and will probably have stood up better than any other asset class that you could have invested in that time.
So are you looking for distressed properties that you would fix? And if so, are you concerned about the higher cost of renovation potentially because of tariffs?
Yeah, so tariffs are a big concern these days.
Yeah.
They have a real impact on pricing. Tariffs are a tax. And so we're seeing the pricing of things, everything from lumber to steel to appliances to finished materials going up in price. Tariffs cause inflation. And inflation is bad. Well, it's good, actually good for us as investors in general because inflation means rents are going up, but it also means our expenses are going up, our energy costs are going up, our labor costs are going up, our materials are going up. And then tariffs also cause a lot of uncertainty in the market. I mean, we've seen that over the last couple of weeks, just with these tariffs coming on and going off and people just not really being able to plan their businesses for the next 6 months because they don't know if we're going to have tariffs or not. They don't know if
they don't know the price of things. It's hard to write a business plan when you don't know what things are going to cost.
Exactly. We're in the middle of underwriting, not just underwriting, but we're getting pretty close to launching our first big new construction project. And the big thing that we're contending with right now is this is a $70 million multifamily build.
Ooh.
We need to figure out what the price of lumber is going to be. We need to figure out what the price of sheetrock is going to be, what the price of appliances and lighting fixtures and plumbing fixtures and all those things are going to be. And tariffs can impact the price of those materials by 5, 10, 20, 30% or more. And so we have to have multiple underwritings, multiple contingency plans. And so, yeah, tariffs absolutely make things more difficult. I am hopeful that what we're seeing in the political world when it comes to tariffs settles down over the next couple of months. I'm hopeful that it's a negotiating tool and that whatever negotiating it's currently being used for is figured out in the next few months and we can get past it. I think at some point pretty soon we're going to see a bigger rebellion by business owners over these tariffs. And I think there's going to be a much bigger outcry if they last much longer. Because again, business owners, if you can't plan for your business, all you're going to do is you're going to sit back, you're not going to expand, you're not going to grow, and that's going to hurt the economy. And at some point, hopefully somebody will step up and say, hey, this isn't working. We have to do something differently. So I'm hopeful that the tariff problem solves itself in the next few months. But yeah, until then, it definitely creates some issues.
So are you underwriting at the higher possibility, like figuring that costs will be 25% higher?
Yeah, so we are doing basically multiple underwritings. and we're doing sensitivity analyses. So basically we're saying, hey, if the tariffs don't take effect, if prices are going up their regular 2 or 3 or 4% a year, which is what we normally see for material costs and labor costs, then this is what the projected outcome of the project will be. We also do a separate one where we say, hey, if we're seeing a 10% increase or a 15% increase in material costs and a 10% increase in labor costs because of immigration issues or because of other issues, here's what the potential outcome of the project would be. And then we're kind of doing sensitivity analyses between the two so we can see here's your best case scenario, here's your worst case scenario. And we're basically having to go to our investors and say, hey, this is what we expect. But in a best case, it could be a much better. In a worst case, it could be a lot worse. And investors are basically now being put in the position where they're taking some additional risk because they don't know if things are going to be towards the good end or the bad end.
Yeah, I mean, I think that's how you move forward at a time of uncertainty. Like we have a build to rent syndication right now, still open for a short amount of time. It's closing
Yep.
soon. But when we underwrote it, we didn't really know where interest rates were going to be at the time we'd be getting construction loans. So we underwrote it high, at the high 9%. Because that's kind of where things were and where we didn't think that it was going to go down. Well, we were able to get a rate in the sevens. So everything just is better. But because we underwrote it worst case, then we're prepared. And if we do better than that, well, it's a bonus to the investors. So, I mean, I don't want people to be afraid of not moving forward. You just have to pencil correctly. You can't be best case scenario. Would you say that over the past 4 years, a lot of commercial investors were only underwriting for the best case scenario?
Yeah, I think we were in a situation that for 10 years, the market was great. I have investors that come to me and say, how have your previous deals performed? And what I have to tell them is, look, I can tell you about the success of my projects from 2018 and 19 and 20 and 21 and even a little bit into 2022, but you shouldn't be impressed by that.
I'm still impressed.
Yeah, well, but the reality is a monkey could have come in and run a lot of deals in 2018, 19, and 20 and made a ton of money, just because when the market's working with you, it's hard to fail. Where things actually get interesting is when the market's working against you and you have to make those hard decisions and see how you're doing. And so, yeah, I think a lot of people got into this idea. They got this idea in their head that because things went so well from like 2016 to 2021 that they were geniuses. And they discounted the possibility that maybe they weren't geniuses and the market was just helping them. And so when you start to believe you're a genius, you think, okay, well, if I just do exactly what I've been doing, then everything's going to work out the way it's been working out. Problem is when the market changes, you can't do what you've been doing and you have to be able to pivot with the market. And I don't really blame a lot of the people that this happened to, because unlike you and me, Kathy, most investors weren't investing back in 2006, 7, and 8. They didn't go through the last downturn. And if you didn't go through the last downturn, it's been 15 years. And so if you're 30 years old or 35 years old or 40 years old, you weren't investing during the last recession. So you don't know how recessions work. You don't realize that lending can really tighten up and you can't get loans. You don't realize that values go down. And when you have to refinance, you have to come to the table with money. You don't realize that buyers disappear and renters can't pay their rent and vacancies go through the roof. And you don't realize those things. And you hear stories of 2008, but if you didn't actually live it, you don't have the same resiliency than those of us who actually went through it and know what happens during a recession and know that you have to pivot and you have to change and you have to change your underwriting assumptions because recessions can get really ugly. And so, yeah, I think there are a lot of people who will be much better investors if they can get through this period of time and are still investing in 5 years, because they'll be like those of us who were investing in 2007, 8, 9, 10. They'll take all those lessons forward with them, and that'll make them better investors.
It's kind of like I just got back from Utah from an amazing ski week. We got just dumped on. But, if you can exercise at a high elevation and you come back to the coast and it's like, whoo, you're so much stronger. That's what it's like investing today. You're working harder, but you're going to be stronger as a result. I think the biggest mistakes I've made over the years is just being too optimistic, not underwriting for the things that could go wrong, because they will, and not, just thinking that, rents are going to go up at this amount, and, appreciation is going to go up this amount. We are now so ultra conservative that if things don't go as planned, it's better for us, right? Because our plan is actually for the worst case.
Absolutely. And it's really hard when everybody else is being super optimistic in their underwriting and
Yes, it's hard to compete with that, right?
It's hard to compete with that because I look at the same deal that somebody else looks at. If they're being super optimistic, they can pay $40 million for that deal. If I'm being super pessimistic, I can only pay $30 million for that deal. If I'm competing with them, I'm never going to get a deal.
You're not going to win, and you're not going to win the investor, because the investor is going to look at their stuff and think, wow, their numbers look better, because
100%.
they're way too optimistic.
Exactly.
Yeah, so good. Oh, Jay, it's always a pleasure to have you here on the RealWealth show. I hope you'll come back again and visit sometime.
Anytime. Thanks for having me.
Thank you for being here. And thank you for joining me here on the RealWealth show. If you want to keep up with economic information impacting the housing market, make sure to hit the subscribe button in your favorite podcast app so you never miss an episode. You can also visit realwealthshow.com, where we have over 500 free webinars, from starting out as a real estate investor, how to save money on taxes, get asset protection, and so much more. Again, that's at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.